Hi everybody, my name is David Gully and I'm at Bentley University, and this is a first in a whole series of videos on central bank communication. So we have 5 videos laid out. This video is going to be a communications overview, and the second video, what and how central banks communicate. Video 3 is forward guidance. Video 4, the impact of communications on the economy. And the 5th video will be the risks of communication and various current issues. Please do visit our YouTube channel, Bentley University EC391. We have a whole number of videos on lots of other topics as well. So the purpose of this first video is going to be to present a broad overview of central banks' communication. So we've got 4 particular questions we're going to want to look at. Why didn't central banks used to say anything way back in the days of old? Why did they change their minds? In other words, why do central banks communicate now? We'll give some examples of why communication can matter in terms of economic outcomes. And then we'll give a brief outline of recent Fed moves in this area. And then the point here I want to make is that videos 2 through 5 dive into the details of these particular topics. All right, so back in the days of old, and this really goes into as late as the 1980s and even the mid-1990s, central banks really didn't say very much at all. In fact, some central banks said absolutely nothing. They didn't talk about what their goals were, their tactics, their policy decisions, their views on the economy, forecasts of the future economic situation, risks to the economy, etc. They just didn't say anything. The general idea was that what central banks should do is do central banking and not talk about central banking. In fact, there's a very famous quote from Norman Montague, who was a member of the Bank of England: never explain, never excuse. All right? So the idea there is central banks did not say anything. Well, why did they not say anything? In other words, why did they keep quiet? Well, first, there was no political pressure. Governments weren't pressing their central banks to communicate, and so, other things equal, well, they followed Montague's advice and did in fact say nothing. Also, from an economic perspective, and we'll do an example with this here in just a minute, is central banks mostly were focused on trying to manipulate or control or affect real variables, GDP growth, employment, and so forth. And if that's the objective, what we'll discover here in just a minute is what they should do is they should conduct policy without announcing these changes. Now, why did they change their minds? Well, in other words, what happened to cause central banks to start communicating or start talking? Well, there was a huge wave of central bank independence starting in the mid-90s and accelerating into the late 90s and 2000s. And as central banks became more independent, they also started working to keep more focus on keeping inflation under control. And it turns out that both of those implications, more independence and more focus on inflation, require more communication. Moreover, the political situation changed. Once central banks become independent, that does not, and this is crucial here, doesn't imply silence. To the contrary, good central banking requires transparency. In other words, they have to tell the public, the world at large, what they're doing and why they're doing it. And then finally, from a also very practical point of view, during the financial crisis in 2008, a lot of central banks ran into what's referred to as the effective lower bound problem, meaning their short-term policy interest rate hit roughly 0. And so if it hits roughly 0 and they still need more ammunition, it turns out that effective communication can act as a second policy tool to help stimulate economic activity. And we'll see that in a later video when we discuss the concept of forward guidance. All right, so let's look at the first reason in terms of the desire of a central bank to influence GDP and employment. And so let's suppose, for the sake of argument, that a central bank wants to increase GDP and employment. So what they would need to do, of course, is pursue an expansionary policy. In other words, they'd have to shift the agri-demand curve to the right. And you'd expect in the short run that there would in fact be an increase in GDP and employment. And as a side effect here, there'd also be an increase in inflation. And here's the key point we want to make. If these policy changes are not announced, in other words, they're unanticipated, there's more likely to be a real impact on the economy. In other words, a change in GDP, consumption, investment, and so forth, along with employment. And so what we can do is we can visualize this with our standard agri-demand, agri-supply model. So on the vertical axis, we've got the rate of inflation. the horizontal axis, the level of real GDP. Y star corresponds to the economy's maximum sustainable rate of output. Short-run ag supply measures firms' short-run supply decisions, and aggregate demand can conveniently be thought of consumption plus investment plus government spending plus net exports. And so if we started at, say, something like point A, and the central bank wants to pursue an expansionary policy to increase real GDP, that would shift the aggregate demand curve to the right. And at least for a while, real GDP would tend to increase. And of course, one of the side effects would be an increase in inflation. But the key point from the central bank's perspective is that they were able to increase, at least for a while, real GDP. And this works potentially well as long as the policy change is unanticipated. But now let's suppose that the central bank changes how it does the policy. It doesn't do it secretly. Suppose it announces that they're going to do this. So they pursue exactly the same expansionary policy, except this time they hold a press conference or they release statements or whatever they want to do, and they tell everybody what they're doing and why they're doing it. So here's what changes. Now the public has some idea that this is coming, and they understand that, okay, if the central bank pursues an expansionary policy, that this might increase the inflation rate. In other words, their expectations are going to change. And once their expectations change, that has an important impact on how the policy works to influence the aggregate demand aggregate supply model. So let's look at how this might work. Well, so the aggregate demand curve now might shift because households, and firms for that matter, they expect higher prices. And so what happens is spending is accelerated from the future to the present, and when that happens, the aggregate demand shifts to the right. That works to push up prices. Likewise, firms also anticipating higher prices will raise their prices, and when they raise their prices, that will shift the short-run aggregate supply curve back to the left. And so what we'll see is if we start at point A on the aggregate demand aggregate supply model, we'd end up more at something like point C. And so we'll now, in the next graph here, we'll describe what this is. And so what we'll discover is the change in monetary policy is what's called neutral, even in the short run. In other words, it doesn't have a real impact on the economy. And so this is the same graph that we started with in the previous example. And so we're starting at point A. We're having expansionary policy, just like before, so the aggregate demand curve will be shifting to the right. So visually it looks the same so far. But the key point to remember here is now the central bank has announced this policy change. And once they announce the policy change, people's expectations change. People expect higher prices, they run out and they buy more now. That pushes aggregate demand to the right. Firms expect higher prices, so they raise their prices. And what this does is this shifts the short-run aggregate supply curve back to the left. And what we might happen here is instead of ending up at something like point B, like we did in the previous example, in other words, with an increase in real GDP, what might happen is the economy instead might move to point C. So in other words, we start at point A, and say we had an inflation rate of 2%. Now we've gotten to an inflation rate of, say, 4%. So instead of moving from point A to point B, the economy moves from point A up toward point C. In other words, this increase in real GDP that happened when the policy change was unanticipated doesn't occur. So there's a big difference between an anticipated policy change, like we've done here, and an unanticipated policy change, like we did previously. In the unanticipated policy change, we move from point A to B. In the anticipated policy change, we move from point A to point C. Now, what I want to emphasize here is there are what are called frictions in the economy. So examples of frictions might be prices or wages or both that don't adjust proportionally to changes in demand and supply. And so these frictions prevent or slow the adjustment from point A to point C. But the key thing remains is that the more a central bank's actions are anticipated, the smaller the change in real variables, in other words, GDP and employment will be. And so there's an important lesson here. So if a central bank wants to influence or affect GDP and employment, it should not announce policy changes. On the other hand, if a central bank is mainly interested in affecting inflation, it in fact should announce policy changes. So in other words, it might or really ought to communicate what it's trying to do. And so what happens is that central banks from the late 80s and especially into the 90s and 2000s have more focused on inflation. And so what this tells us is what they ought to do is they ought to communicate more. They should tell us more what they're doing with policy. And in fact, that's exactly what they do. It's also important to note that this analysis works exactly in the reverse. So let's imagine that instead of inflation being, say, too low, imagine a scenario where it's too high, and the central bank's goal is to reduce it. So in order to reduce it, they would have to pursue a contractionary policy that shifts the aggregate demand curve to the left, and we'll do a visualization of this in a second. If they don't announce the policy change, there's a high chance that, yes, inflation will in fact fall, but so will output and employment. In other words, it'll happen because the policy change is unanticipated. But on the other hand, if the central bank announces the policy, and there's a degree of credibility here, in other words, the public believes that the central bank will follow through, then the policy change will be expected or anticipated, and there'll be much less of an impact on output and employment. And so now we've got our scenario here. So again, this is our same aggregate demand, aggregate supply model. And let's imagine that we've got a situation, the economy is at point A, so we're at full employment, but imagine we've got an inflation rate that's undesirably high at 15%. So the central bank says, gosh, we want to do something about this. Well, to do something about it, pretty clearly they need to pursue a contractionary policy to say get the inflation rate down to around 3%, just to make up a reasonably round figure here. Now, of course, when they pursue this contractionary policy, there's a chance that if they don't announce the policy change, we might end up, at least in the short run, at something like point B. So notice at point B, yes, inflation is falling, but notice there could be a fairly dramatic impact on real GDP and employment. So the central bank gets the lower inflation that it's after, but it comes with a cost. Instead, if the central bank announces the policy change that we're going to try to reduce inflation from 15 to say 3%, and the public at large buys into this, in other words, they believe the central bank has credibility, what happens again, just like the previous example when we were working to increase the money supply, now it works with reverse with the decrease in the money supply, and we would observe that people expect lower inflation, lower prices, aggregate demand would shift back to the left, and also, and this is what's critical, short-run supply would work to shift to the right. That would work to push inflation downward and also work to minimize the impact on real GDP. And so what we're more likely to observe if the central bank communicates and has credibility, that we'd see a movement from point A down toward point C. In other words, we wouldn't see this really unfortunate detour over to point B. Now, I'm not claiming this adjustment process is smooth or clean by any stretch, but the more the policy change is anticipated, the smaller the impact on real GDP will be, and the larger and more quickly the impact will be on moving the rate of inflation from 15 down to a more desirable, say, 3%. All right, so we need an aside on credibility here. So a central bank is said to be credible if the public believes that the central bank both acts in the best interest of the overall economy and follows words with deed. In other words, they sort of follow the old saying, they talk the talk and they walk the walk. Now, here's what's critical. If a central bank has credibility, the public expects the central bank to be good to its word and then follow through with the appropriate action. So they say they're going to do something, they actually follow through and do it. So here's why credibility really matters from a central bank's point of view. If a central bank has credibility, that can help it achieve its policy goals through communication. If they lack credibility, policy goals through communication doesn't work very well. So let's go back to that previous example here where we had an undesirably high rate of inflation of 15%, and we want to get it down to a much more desirable rate of 3%. So we said, okay, we have to pursue a contractionary policy. In other words, we shift the aggregate demand down to the left. Okay, fine. Well, what we can use then is Paul Volcker's actual situation. He was appointed chair of the Fed in 1979. At his appointment, the economy in the U.S. was facing an inflation rate of 15%. And he said, all right, I'm going to reduce that inflation rate. That's too high. So he did exactly what he said he was going to do once he took office. He pursued a contractionary policy, shifted the aggregate demand curve back to the left. But here's the problem that he faced. Through no fault of his own, and that's what's important here, the Fed lacked credibility. His predecessors had not talked the talk and then walked the walk. All they did is talk the talk and then didn't follow through. So because of this, the Fed and its actions did not have credibility. And so instead of moving from point A down toward point C, in other words, going from the high inflation rate to the low inflation rate and not having much impact on GDP, the economy took this very, very nasty detour back to something like point B. So yes, we got lower inflation, but boy, was it costly. We had a short but very sharp, severe recession. So this is why credibility is so important. Credibility can dramatically improve the outcome that a central bank is trying to achieve. They can get for example, lower inflation without having that much of an impact on real variables, GDP and employment and so forth. And one of the difficulties here is that credibility can take a very long time to build up, but virtually no time to damage. And so it's not symmetric. So it can take years or decades to build credibility. One failure, however, can damage or even destroy credibility. So central banks here, of course, have to be very, very careful. So another reason to communicate more, political considerations. So in the early 1990s, Alan Greenspan was the Fed chair at the time. Politicians were getting very unhappy about the secrecy of the Fed. So politicians, of course, decided they should try to do something. And so what they did is they introduced a number of bills that would have forced the Fed to be more forthcoming with its policy decisions. Now what the Fed did in kind of classic bureaucratic response, and in conjunction with or along with a February 1994 policy rate hike, they talked for the first time. In other words, what they did is they released a statement after their open market committee meeting saying we raised interest rates, and tried to give a very short explanation why they were going to do so or why they had done so. And it turned out this was really very successful at easing a lot of the political pressure on them. And what we'll do later on is talk about the concept of forward guidance when other policy tools are exhausted. So there's a whole lot more in terms of the dimensions of communication to talk about. So we're just talking about a very narrow part of it. And so here, just as an example, is their very first press release dated from February 1994. And so, Chairman Greenspan announced today that the Open Market Committee decided to increase slightly the degree of pressure on reserves position, so they don't even come out and say they're raising the federal funds rate. Action is expected to be associated with a small increase in short-term money market interest rates. Decision was taken to move forward toward a less accommodative stance in order to sustain and enhance the economic expansion. And so the short translation is we're raising the federal funds rate. But even still, they were sort of vague and indirect about it. But it was a start, and they've improved dramatically in terms of the clarity and the detail and the depth of their communication since then. So it turns out that that initial policy statement opened floodgates. So initially it was kind of a slow motion flood. Starting in 1995, the Fed started to release transcripts of their open market committee meetings with a 5-year lag. Starting in 1997, they started to announce, instead of general changes, they announced actual target values of what the federal funds rate is. In 1999, they started expanding the scope of their statements where they talked about what they referred to as the balance of risks. Starting in 2002, they released, or they noted, dissenting votes in FOMC decisions. 2004, they accelerated the release of FOMC minutes from 3 weeks to 6 weeks. 3 weeks is pretty much as fast as they can run through the production process there. And then once the 2008 financial crisis hits, they really, and this not just them, but other central banks as well, dramatically increased the scale and the scope of their communications. So in November 2007, they released their first summary of economic projections. In November 2008, they started to pursue large-scale asset purchases, in other words, the various QE programs, and so they had lots of communications regarding those. And then in terms of forward guidance, in December 2008, the Fed lowered the federal funds rate down to effectively the zero lower bound. And as a consequence, they started with forward guidance. And in a future video, we'll talk about why forward guidance is so important. And then in April 2011, then Chairman Ben Bernanke started holding press conferences. 2012, they issued their first statement on their longer run goals and also their blue dot plot that we talked about in a previous video. And then in September 2014, when they were starting to move toward a more, what they refer to as normal policy, they released their policy, their first normalization principles and plans. And then January 2019, then Chairman Powell, or now Chairman Powell, moved to press conferences after each and every open market committee meeting. And so what we want to sort of close with here are the benefits of central bank communication. So I've taken this from a Federal Reserve Bank of San Francisco publication, and I've edited down for brevity, but it's basically from them here, so I don't want to take credit for it. So the first point is, can be sort of attributed to Ben Bernanke, is that transparency is a responsibility of central bankers because their decisions matter so much in terms of their impact on the economy. So as Ben Bernanke said, public servants whose decisions affect the lives of every citizen, central bankers have a responsibility to provide the public with as much explanation of those decisions as possible. So what are the other benefits? Well, there's also some evidence that central banks, not just the Fed, but other central banks, produce better forecasts. So if they produce better forecasts, then if they can communicate this information to the public, these better forecasts help the public make better forecasts and make better and more anticipated decisions regarding the actions of the central bank. So it can reduce uncertainty. Also, the transparency increases the predictability of policy changes. This allows for a smoother adjustment and also, again, allows for reduced uncertainty. Transparency can also help anchor the public's long-term inflation expectations. So consider the example we did a few slides ago, moving the inflation rate from 15 down to 3%. The idea there is that as long as the central bank can convince the public that inflation will remain low and stable, that helps inflation remain low and stable. Or in the example we did, if the inflation rate is too high, that helps move the inflation rate down to a more appropriate level. And then finally, transparency gives policymakers an additional incentive to organize their thoughts. And this is from Bill Poole. An advantage of transparency in this sense, familiar to every teacher and researcher, is that the best way to be sure that you understand an issue is to explain it to others. And so this explanation forces a central bank to be clear in terms of what they're doing and why they're doing it. So in summary, central banks used to be very closed-mouthed about what they did with their policies. Now they talk constantly, almost without exaggeration here, and the intent of their communications is to influence expectations of the public. And expectations of the public, it turns out, can help them achieve their policy goals. And so in our next video, we'll talk about what central banks can communicate and how they can go about doing so. Thank you.